Hey everyone, thank you for purchasing the Precision Markets Forex Trading course. Just before we get going, I wanted to talk about a few market basics. Most of you will probably know this stuff, but some of us may not, so I thought I'd just go over a few things. If you're a complete beginner to Forex and you don't know anything about it, there's probably going to be some things in this course I'm going to leave out, and the simple reason being is there's a bunch of sites such as Baby Pips being my favorite one. If you just go to babypips.com, click on education, and go through their whole process, they'll teach you all the basics of Forex, and it's completely free. That way I don't have to take up any more of your time on this course with the basics for those of us that do have a little more advanced knowledge. But there are a few basics that you do need to know. Spread. Understanding pips and spread. So let's say Euro USD is at 1.17185 and it goes to 1.17195. That means Euro USD has moved a pip. That's a full pip. The fourth decimal point is a pip. Now the fifth decimal point is a decimal point of a pip. So if we go from 0.92 to 0.95, that's 0.3 of a pip. With smart money concepts, this trading style requires very tight stop losses. I recommend you have a very good broker with tight spreads and low commissions. I'll recommend one somewhere in the description. Now the way spread works is, let's say your spread on Euro USD is 0.3 of a pip. When you're selling, you're going to add 0.3 of a pip to your stop loss. When you're buying, you're going to add 0.3 of a pip to your buy. You're going to front run it to make sure your order gets tapped. If the spread difference is 0.6 of a pip, you'll front run the buy by 0.6 of a pip and you'll add 0.6 to the stop loss of a sell. It's very important you get this right. You should not be trading during news. I do not recommend it one bit. If you're holding a position during news and you have zero risk in it, that's fine. By zero risk, I mean you've either paid yourself with partials or you are break even. Either way, you shouldn't have risk in the news. And the most important news are always red. If you go to forexfactory.com, anything that's red, if it affects the currency pair you are trading, I would advise waiting for the news to come out or have risk off if you are in a trade, just in case, because we never know which way news are going to go. Now there's a thing called slippage, and some people don't understand this. It's a very simple concept. Slippage happens when price comes through your stop loss really aggressively. It's very important to know ahead of time how your broker is with slippage. Some brokers will close your position exactly where the number is no matter what, and some brokers will have pretty bad slippage where you'll put in a 2 pip stop and price comes through it so aggressively you end up eating 4 or 5 pips. What this basically means is if you were risking $500 with a 2 pip stop and it ended up coming through your stop loss and it didn't take you out of the position till about 4 or 5 pips, you'll lose, $1,000, $1,250, somewhere in there instead of the $500 planned dollars. And this is very important to account. Many of us will be going for prop firm funds and challenges and those sort of things. Some of the prop firms do not allow you to trade news, others do. What's important to know that if you are going to be trading news, you need to allow for slippage. It's just best not to be in any trade during news, or at least have risk off. But the reason this is so important is prop firms often have maximum day allowances for how much you can lose. So if you can lose $5,000 in one day, and let's say you've already lost $4,000 for example, if you went and planned to lose $500 on this trade, but then the slippage was so bad that you lost $1,200, you'll actually lose your account, and you need to account for slippage. Obviously, we'll get into the risk management section where we talk about proper management, and most of you will likely stop trading after you've lost, 1.5%, 2.5% on a prop firm. That's enough. On your own account, you may choose to lose, 3 or 5% depending on the size of your account. Totally up to you, but you definitely have to account for slippage. Every broker's different. Time zones, kill zones. Myself, when I first started trading, I got taught by a couple of guys actually to trade on London time and always be on London time. And the reason being is a couple times a year, the time zones change and we go into daylight savings time, or we leave daylight savings time. What happens is London switches their time different than North America does, and they're usually a month ahead of us and 3 weeks behind us on the way back. And what this does is it actually kind of offsets your kill zone to make sure you're in the right time zone all the time. You run on London time. That is UTC +1. Now, London kill zone starts at the Frankfurt Open, which is 7 a.m. and it'll go till 10 a.m. Between 10 a.m. and 1300 is a bit of a lull where volume is lower. And in that lull, there's still trades, but there will be less trades due to the lower volume that are high probability. So come in New York kill zone, which is an hour before New York, which is 1300 UTC +1, which is London time. And it goes till 1600. Now, realistically, you can trade from 1300 to 1700, but 13 to 1600 is your highest volume and your highest probability. There is a Tokyo kill zone. Not many people trade Tokyo, but if you do, it is basically an hour before Tokyo opens and 2 hours on the other side of it. If you are trading Tokyo, I recommend obviously picking some Asian pairs. You know, Australian dollar, Japanese yen, New Zealand, that sort of thing, something that'll be more likely to move during that session. Now, a trading plan needs to have a couple of things, and this course will get you there. I'll show you every one of these things in detail. I'll give you my own trading plan. Whether you choose to follow it or not, it's completely up to you. My guess is you'll take my plan and refine it to what fits your own psychology. But a trading plan's got to have a morning checklist where we go through structure, pricing, protected and targeted highs and lows, premium and discount. We have entry criteria, exit criteria. We'll talk about where we'll partial out, where we'll break even. Risk management is going to change whether you're pro trend or counter trend. Same with partials. You'll have to figure out how much risk per trade idea you're willing to risk. You also got to figure out how much time you're willing to spend in the market. Are you going to sit in front of the charts for 12 hours a day? Or are you going to sit in front of the charts for 3 hours and maybe call it a day? For those of you in Europe that can trade both sessions, chances are you'll sit in front of the charts for a couple hours, leave, and come back. What I'm getting at is you don't want to be in front of the charts for 12 or 14 hours, because the idea of trading is freedom, and there's no freedom if you're a slave to the charts. With that being said, time spent in the markets also means how many wins are you willing to walk away at? How many losses are you willing to walk away at? How much percentage are you willing to lose per day or per week before trading is done for you? All of these things got to have a plan in place, because trading is very systematic, meaning that you need to create a system and you need to repeat this system over and over and over. Now, if something in your system's not making you profitable, you keep switching things out till you get profitable, and then you just rinse and repeat. And that's ultimately what trading is all about, is having higher probability setups and having proper risk management. You're basically getting paid to wait and wait and wait, and you're ultimately waiting for the highest probability setups. So that may mean you might have 3 or 4 trades one day and 0 trades the next day, or whatever the case may be. We don't force the market, we let the market come to us. Now, the last thing I want to touch on is journaling. How you want to do this is completely up to you. These were actually my trades from today. I took a loss on the first one, didn't quite cover enough, which is totally fine. The second one finally went for me. Now, what I want to talk about is you need to keep track of what your win rate is, what your loss rate is, what your break-even rate is, or at least how many hours a day or a week you're averaging, whatever the case may be. Now, you can do this through an Excel spreadsheet. You can write it in your trading journal manually by pen, Or you can do what I do is I take a screenshot at the end of every session and I just lay out my trades just the way they happen, win or lose or break even. And what I'll do is I'll call that screenshot Euro USD October 15th, for example, and then I'll put it in the October folder. And if I ever want to refer back to it, or during the weekend when I do want to go through all my trades, I'll go to my trading journal and I'll check it out. So however you want to journal, again, completely up to you, but I highly recommend you find a way of journaling your trades. And this is kind of the easiest way for me because I'm a very visual person. You may be more of a Excel person, whatever works for you. Just, yeah, don't forget to journal. And now that we've gotten through the basics, let's start with the main course.